Welcome to Private Capital Perspectives, a podcast from The Lineup. This podcast is where family offices, real estate operators, and investors share how they're deploying capital and navigating today's private markets. I'm John Pugh, a family office capital partner, real estate developer, and investor, and I'm also your host. Each episode, we bring you real conversations from the front lines of private investing. I promise no fluff, just practical insights on what's working now and what's coming next.
Hi there, everybody. Today on Private Capital Perspectives, we're joined by Mark Stroud Jr., President and CEO of Lindell Investments, a Tampa-based family office managing over $200 million in equity with a focus on opportunistic real estate equity and private credit. A Tampa Bay native and summa cum laude graduate of Florida State University, Mark brings a sharp financial lens and deep local insight to his role, where he leads a team of 7 professionals across originations, underwriting, asset management, and investor relations. Before Lindell, Mark cut his teeth in commercial lending with C1 Bank and Bank OZK, and today he remains an active leader in the community, serving on the board of the First Tee of Tampa Bay as a treasurer of ULI Tampa Bay and as a member of the Copperheads. Mark lives in Tampa with his wife, Kelly, and their 2 sons. We're excited to dive into where he sees opportunity in today's market, Lindell's private debt and preferred equity strategy, and what it takes to build a resilient family office platform. Let's get into it. Thanks for joining today, Mark.
Thanks for having me, John. Good to talk to you.
Yeah, absolutely. So just you and I have known each other a couple of years now, and I think when we first met, I asked you this question. I'd love to ask it for our listeners and viewers. When people ask what Lindell Investments does, how do you usually describe it?
Yeah, that's a loaded question, and I'm sure that's probably how I answered it the first time that you and I met. But look,
That's right.
Lindell Investments, it's an entrepreneurial, diversified family office. We're founded by an entrepreneur. The Lindell family has been in the Tampa Bay business investment area for over 50 years. Carl Lindell came to Tampa in the 60s. Started out in the car dealership business, ended up, building out 8 dealerships across the west coast of Florida, had, Volkswagen, Honda, Acura, Subaru, you name it. Was very successful in that business, allowed him to start a family office, sold out of that business when he got into real estate development. So, we've kind of got roots being entrepreneurs, being risk takers, being businessmen. And, we've kind of grown into investors over that time. So, we're a discretionary family office, but we're very much entrepreneurs at heart. We're looking to support other entrepreneurs in their endeavors. And, most of the time we're focusing on real estate entrepreneurs.
Interesting. I think people with Carl's background and really understand entrepreneurs. I think it's such an important part of investing, and obviously building a business. He's had a lot of great success with that, and it's great to work with someone like that who really understands kind of how to build things, which is kind of cool, right?
That's
So
right.
maybe
Yeah.
if you could speak a little bit more specifically to Lindell Investments and your investments philosophy, kind of how do you kind of view the world today, just from a really high level, and when you're looking at allocating capital, how do you kind of see things?
Yeah, no, it's a great first question. I think, over the last, I've been a Lindell Investment since 2017, right? So over the last 8 years, the way that we see the market has changed pretty significantly. Obviously, since 2022, when, the Fed hiked rates, 500 basis points, that really changed things for everybody, kind of pre 2022, when things were kind of stable, steady, you kind of, you didn't have a crystal ball, but generally you knew within a standard deviation what the world was going to look like, 3, 4, 5 years down the road. You can make investment decisions and feel pretty comfortable that, the rug's not going to get pulled out from under you. We were very much risk takers. We're entrepreneurial. We're willing to go out on a limb and get things done, right? Take a little bit more risk, but, chase a little bit more yield, a little bit more return. And, Carl loves that. He's generally, a cowboy at heart. That's really what he likes to do, is take on risk and kind of pick his pick his spots, mitigate where he can, but go after the big paydays, right? The world has changed since then. And, that means that we all have to adapt. The way that we look at the world today is like, look, there's way too much choppiness in the market, way too much volatility in the world, right? I mean, it seems like things can change depending on what the president decides to tweet this week.
Sure.
Case in point, what happened yesterday between
Yeah.
him and Elon Musk. I mean, I don't even know what the Treasury's doing today, but I'm afraid to look. So our investment philosophy today is much different than it has been in the past. We're still are looking opportunistically for those like home run deals, right? Those opportunities to invest equity capital, take the downside risk, but also chase after the upside. That's in our DNA, and we really want to be able to do that. But at the same time, we have to be realistic. We are very careful about choosing our spots. We're keeping a lot more dry powder on the sideline than we ever have in the past, in both cash and in our securities accounts. And really, it's just because things just don't make sense, right? Like, if you want to go build something new today, generally the cost to construct is greater than the value of the asset if it were stabilized, right? That's specifically true in the multifamily space, really across the board in most of the markets that we do business in. If you want to go purchase an asset that's already stabilized or is near stabilization, I mean, generally the yield that you have to go purchase an asset at, you're taking on negative leverage, in order to, buy something at a market clearing price. And you are completely reliant on future rent growth and or interest rates coming down in order to generate your return, right? Like if I wanted to take a 4.5% return, I can just go buy an apartment deal, but I don't want a 4.5% return or a 5% return. I can go buy treasuries for that,
Sure.
So what's the point of taking on risk and illiquidity? Right.
100%.
If you want to plug in all these assumptions into your model and, say I'm going to get, 4 and 5 and 6% rent growth and, the treasury rate's going to come down and I'll sell it at a 475 cap in year 3, then you can financially engineer yourself to a mid-teens return. But I'm not willing to do that. I don't underwrite that. I don't think that's reasonable in the market today. So it's really, we kind of are between a rock and a hard place when it comes to, putting out true equity capital. Just because, like I said, the way that we look at the world, things just don't really make sense, right? There needs to be some sort of reset basis in order for us to be able to transact, materially, right?
So just zooming out, how are you, and you don't have to give me a lot of detail, but what from a percentage standpoint in terms of capital allocation, are you looking to allocate more of your capital towards, is it, I don't know, you're looking at 30-40% private debt and 20% private equity, real estate, and private equity, business investment, or like how are you kind of, does it have a larger kind of strategy from a capital allocation standpoint, the
Yeah,
portfolio?
good question. We don't have targets that we try to meet from a capital allocation standpoint.
Okay.
We're very much a group that, Carl likes to keep things a little bit more informal here. Is I came from a banking background. I try to, build structure and process. And Carl's an entrepreneur and he likes to be flexible, right? And he likes to be able to react. And that's one of the great things about being a smaller family office is that we can be flexible and we can react. We don't have, 3 levels of investment committee in order to, change what we're doing. The investment committee is basically myself and Carl has the veto.
Sure.
So it's funny how that works. But we've got kind of 4 legs on the stool of our family office, right? We've got liquidity, cash and stocks and bonds. We've got private equity, which is mostly fund investing in operating companies. There's sponsors that do that. Although we do have some one-offs, and I'll talk to you a little bit about one of them that I'm very, very excited about. And then we have private credit, and then we have real estate, right? Those are the 4 legs on our stool. At any given time, probably 20%, give or take, is in that liquidity bucket, especially today, maybe it's 25%, right?
Sure.
We're more liquid than we have ever been. Um, In the private equity space, it's a smaller piece of the pie, maybe 10 or 15%, right?
Mhm.
The real estate space has traditionally been the largest space for us. That's, where we're an alternative asset manager for the family, right? So, I mean, and that's really our specialty is real estate. So historically, that's been where we've been the heaviest, right? We're starting to kind of transition some of that capital allocation out of real estate and into the credit bucket, right?
Sure.
And most of the credit bucket is still real estate centric, right? It's still attached to
Mm.
real estate. It's just not equity in real estate. It's credit
Mhm.
backed by real estate.
Yeah. And so, yeah, just to speak more to that, I mean, I can certainly guess, and I feel like I have some understanding of why, but what exactly is this new focus on private debt? What's kind of driving that private debt focus?
Yeah, I mean, kind of what we just talked about, right? It's really hard to allocate capital these days into what is our, specialty, right? Which is real estate, alternative assets. It's hard to allocate capital there and feel good about it. A, feel good that you're going to get your principal back. B, feel good that you're going to get any sort of return on
Yeah.
your principal
Yeah.
anytime soon.
Sure.
And C, just sleeping at night. I mean, like, shoot. So it's been tough for us, right? So we
Mhm.
kind of had a discussion at the end of last year. We were doing more and more in the preferred equity space, the mezzanine space. We
Yeah.
even closed a couple of bridge loans, between late 23 and the end of 2024.
Yeah.
Despite the tax impacts of ordinary income on a loan versus capital gains for an equity
Mhm.
investment. Um, just we just found ourselves doing more of that sort of business as it kind of came to us. And we kind of had a conversation at the end of 2024 where we said, you know what? If this is what we feel comfortable doing and it's kind of organically come to that, where people came to us with these sorts of opportunities, and we looked at those and we looked at the risk adjusted return of that versus the risk adjusted return of putting equity out.
Mm.
And we decided to do those, subordinated debt and bridge deals instead. Like, let's
Mhm.
just formalize it. Let's build a business around it and let's allocate capital to it and see what the business looks like after we filled that capital allocation. And that was,
Yeah.
kind of the business plan that we set up at the end of 2024. We
Mhm.
went ahead and we hired a full-time employee, started in April of 2025. So, just a couple of months ago. Really, he's like 7 weeks in.
Okay. And that's Brad,
And
right?
his job is
Yep.
originations and building that pipeline and kind of managing the closing process. We only allocated $30 million to start, so not a huge allocation, but a decent size. I mean, I think he's going to have 12 or 13 million in the portfolio by the end of June.
Wow.
So
Okay.
pretty.
And so can you speak a little bit more to the like some of the preferred private debt structures that you're really looking for to put your money in?
Yeah, no, absolutely. So I've kind of put this in two separate buckets, right? You've got like subordinated debt, which is kind of mezzanine loans, preferred equity, right? And then you've got true first lien mortgage debt. Okay, so two separate boxes. On your preferred equity and mezzanine stuff, generally, we're writing checks between, you know, we'll go as small as $1.5 million up to 15 million, right? On the preferred equity and mezz side, we prefer to structure as preferred equity over mezzanine just for the tax consequences. You kind of you get a little bit more security in a mezzanine situation because you're taking a UCC lien on membership interest in an entity. It's a 10-day foreclosure process if something goes wrong. So
And
you have
just for
more
those who don't
control.
aren't familiar with it, I don't, what's a UCC lien? What is that exactly?
UCC is a uniform commercial code filing. On non-real estate collateral. You don't have a mortgage that you can file in the public record because there's no real estate to file a mortgage on. Basically, the mortgage is a UCC, Uniform Commercial Code filing. So you file a UCC in the public record, and the UCC filing statement states what that UCC is secured by. So you would secure it with the membership interest in the real estate holding company, for example. So instead of foreclosing on real estate and wiping out the equity, you're foreclosing on an entity and
Got it.
wiping out the equity.
Got it.
But either way, the outcome is the same. You end up owning the equity in the real estate. The difference is in a mezzanine loan, you're still subject to the senior, right? So, you're investing behind senior debt. That's why you call it subordinated debt. You're subordinate to the senior lender, which has the mortgage on the real estate and all that stuff. So it's a little bit more risky, right, than a traditional loan because you're
Sure.
in second position. But it's way less risky than taking the equity risk, which is
Yeah.
the last to get paid,
Yeah.
right? So again, we prefer to do preferred equity versus mezzanine note because mezzanine is a loan, it's a contractual interest rate. It gets taxed at ordinary income rates, which is not very tax efficient as a family office. I mean, like the first question is, does the deal work? The second question is, what are the tax consequences? Every investment, you
Yeah.
know. So
Yeah.
it's all about after tax return to us. So we do preferred equity mostly when it comes to those subordinate debt deals. That's
Mhm.
basically a mezzanine loan that's structured as equity.
Mhm.
It's
Mhm.
subordinate to the senior. You don't get a UCC lien on the entity, but you get certain rights inside of an operating agreement where if the sponsor, the equity holders default, you take over ownership, management of the entity, and you can protect your rights and protect your investment that way.
Mhm. Mhm.
Um, a little bit more risky from a control standpoint, but much better from a tax standpoint. We think internally that it's worth the extra risk in order to get better tax treatment. And our operating agreement's pretty solid. But we're again kind of like that $1 to $15 million check size. We're investing all throughout the Southeast, with a primary focused on Florida, but throughout the Southeast, we'll go. We've got stuff in Atlanta, Charlotte, Nashville, that sort of thing. Um, and generally, we're trying to hit like some sort of double digit to mid teens return on a coupon. So it's a fixed income product. Generally, we don't get upside unless we're, investing higher in the capital stack.
Mhm.
But, generally your first mortgage loan is going to take you 55, 60% loan to value. We'll take you from that 55, 60 to 75 or 80, you know, and so we're that piece in the middle. And generally we'll price that between 13 and 16%. We'll charge a couple of points, and ideally we're in the deal on a new development deal for like 3 years, because that gives you enough time to build it and stabilize it. And by then you should be either selling it or refinancing me out because I'm expensive capital,
Yeah.
right?
Yeah.
Well,
Are you
you have to
seeing are
step in.
are are more sponsors coming to you with requests for mezz or for preferred equity? What's their typical ask as opposed to what you guys want?
Well, I'll tell you what, every single sponsor in the world is coming to me with requests for limited partner equity, for LP equity.
Yeah.
And,
Yeah.
I'll,
And then
I'll have that conversation and say, hey guys, look, I understand on your numbers, this might look
it's not.
semi attractive, but
Yeah.
by the time I skin it and I comp it to what's actually in the market today, I know it's not going to look as good as you think it does. I mean, developers are paid to build buildings. They're not paid to allocate capital, right?
Exactly.
So they're not
Yeah.
taking the capital risk that I am. I have to be the one that, I mean, equity always has to be the one that kind of moderates
Mhm.
activity when things get too frothy. And that's kind of the
100%.
role that we have right now. So I get requests for LP equity. I say, hey man, look, this doesn't work for me as an LP. I'm sorry. Uh, if I like the sponsor, I like the deal, and I like the location, I'll say, hey, if you're interested, if you can find an investor willing to come in behind pref, I can be a preferred equity or a mezzanine guy. You let me know. And generally, I won't hear from them again, but maybe 30, 45 days later, they circle back and say, hey, I found an investor that is willing to write a smaller check behind preferred equity. Great. All right, let's look at it. I'll size it for you. And
Nice.
that's where it goes. But between the pref and the mez, most people want pref versus mez. Much easier to deal with your senior lender, right? Banks don't like mezzanine debt. They don't like hard subordinated debt because they have to look at it as debt too. They have to, incorporate the payments on that. There's an intercreditor agreement that the bank is going to have to enter into with a mezzanine lender. They don't do
Mhm.
that with preferred equity. Generally, they just approve who the preferred equity partner is, and that's it.
Yeah.
So much easier for the bank. They look at preferred equity like equity. It's
Sure.
just like it's all treated the same to the bank, so they don't care. On a mezzanine
Yeah.
loan, it's additional debt, more
Mhm.
leverage. The bank cares about that. So
Well, let's get a little bit dig a little bit more into kind of what are some of the themes or sectors in real estate that you're continue to have some excitement and passion for? Because I think there's been, I don't know, it seems like our markets, like you were saying earlier, markets have shifted a lot. And have you lost any appetite for some things you were interested in before, or you kind of continue to kind of take an interest in multifamily is one you mentioned before? Are you still interested in that? Are you broadening out in terms of product types that you're investing in?
Yeah, I mean, look, I think no matter what, real estate's about location and basis, first of all, right?
Sure. Yeah.
There's some asset classes I think that are more operating businesses than they are real estate plays. That's hotels, that's assisted living, skilled nursing, that sort of thing. Those are operating businesses. I'd say that we're shying away more and more from, the true operating business type asset classes. If somebody asked me to invest in an assisted living facility, I'm going to say no off the bat. It's just a non-starter. Skilled nursing, no off the bat, non-starter. Equity in a hotel, no off the bat, non-starter. But if you wanted a bridge loan secured by a hotel, or if you wanted a preferred equity investment or a mezzanine investment in a hotel, I'd consider it depending on where my last dollar exposure is. If I feel comfortable at that basis, then I might do it. Where do I feel comfortable these days? I mean, like nowhere, but I really like, I like industrial and multifamily. I feel like those are pretty stable asset classes. I don't think there's a ton of upside per se in each one of those asset classes today. I mean, you
Yeah.
might be able to buy multifamily and, if some of these assumptions that we just talked about at the beginning of the conversation do come true, rates come down, rent growth, really kicks off, there could be upside there over, I'd say more of the intermediate to long term versus the near
Mhm.
term, but I think those are stable. I'm interested in investing in those asset classes for sure. In fact, the only equity deal I closed last year, I closed one LP investment, and it was an industrial deal. So
Okay.
that's the kind of how we feel about those asset classes. The asset class that I'm getting more and more interested in though is retail.
Mm. Okay.
Um,
Mm.
we've done a couple of retail deals over the last couple of years, mostly value add. They've come out well. Um, Look, more and more, I'm trying to find ways to put capital to work without taking undue risk, right? And like you talk about, like building a multifamily complex, you're taking development risk, construction risk, lease up risk, and then market risk on the back end. That's
Yeah.
a lot of different risks you have to take. If you're doing a retail deal, especially like a single tenant retail deal, I mean, like even an industrial deal, I mean, you can pre-lease 90% of it, you know what I mean? Or 100% of it before you even have to close on the dirt, like that. You're kind of covering the leasing risk there, I mean, like you're locking in what your yield on cost is going to be. You sign a GMP contract with a contractor, or you don't even build it. You just do a ground lease,
Yeah.
right? I mean, like
Yeah.
you really take the construction risk out of the, you know, out of the equation. So
Yeah.
if you can still earn mid-teens to high teens, low 20s on something like that, risk
Mhm.
adjusted, that feels pretty good, man. So we're
Absolutely.
doing some of that these days. We're dipping our toes in, doing a Chase, a Chipotle. I've got a deal in Fort Myers that we just submitted a term sheet on the other day. That's like a Wawa and a Portillo's. I mean, not big equity check sizes, but
Yeah.
from a risk adjusted return standpoint, it's worthwhile for us to jump in. And if we can do them at scale, do multiple of these at the same time, then it certainly starts to make more sense for us. We have dabbled in office too. Obviously, there's been some bottom feeding opportunities in office. Um, we were lucky enough to invest with Andrew Wright in the Urban Center deal just down the street here. Very happy with how that's turned out. We bought the Fifth Third Bank building across the street from our office back in 21. I mean,
Okay.
that's the best deal in the portfolio. you know,
Really nice.
we've kept that thing 100% full. We've got 3 credit tenants that have come into that building since we bought it. We underwrote it at 26 bucks a foot. We're getting mid 30s now. It's just,
Fantastic. Wow.
the office has been really, really nice.
Mhm.
It's been probably a year since I've actually seen an office opportunity that is actionable. I
Yeah.
feel like we hit the bottom. We did a couple of deals, wish we did more. And, now the opportunities are kind of fewer and further between, but we're still looking for those.
you mentioned you guys did an industrial deal as an LP last year. Could you maybe speak a little more to, you don't have to go too much detail, but a little bit more to specifics around why that was the right type of opportunity and what maybe it was the sponsor, it was the dirt. Like, I'm just kind of curious, kind of how did you get comfortable with that, and what were the return kind of profiles you guys were looking at there?
Yeah. Yeah. Really interesting deal introduced to us by a really good friend of the firm here in town, fund manager who was also investing in the deal. The fund was not large enough to cover the entire equity check. So the fund manager came to us knowing that, we could write sizable checks, and said, "Hey, would you guys be willing to write a sidecar?" They needed about 7.5 million bucks. This is about 1 million square foot uh, industrial park in Greenville, South Carolina. It's part of a much larger park, but the 1 million square feet was the first phase of the park. Um, it had a bunch of bells and whistles, right? You had options to participate in the rest of the park on about the same terms. The developer themselves, the sponsorship was absolutely incredible. It's a group out of Greenville. Their office is 10 minutes away from the site. They are an institutional developer. They've got offices all across the southeast. Great reputation. No matter what it is, they do multifamily, they do industrial, and they do retail. And they've been very successful in all three of those asset classes. I know multiple institutional investors who have partnered with them who had great things to say about them, about their ownership and leadership. It's kind of like a family owned business. The two brothers that started it still own it, still actively involved. In fact, one of the brothers who founded it is this is his deal. He found it. It's his baby. He's on site like every day. So that really makes you feel warm and fuzzy. Now there's definitely a supply backdrop in that market
Sure.
that we would not have been comfortable with. However, in this particular deal, out of the four buildings that were there, three of them were pre-leased to national or international credit tenants before we had to close.
Yeah.
So there was as BMW's got a large plant in North American headquarters in Greenville, South Carolina. So the largest like OEM for BMW, this is going to be their North American headquarters, so they
Okay.
took two buildings, a subsidiary of Toyota took a building, so I mean, that's kind of what you're talking about in terms of credit quality.
Mhm.
Um, so we felt really comfortable there. The spread on yield on cost to, cap rates, we had over 150 basis points of spread. And when you're talking about the true dollars that you're talking about here, I
Yeah.
mean, that's a lot in
Absolutely.
actual dollar return.
Hmm.
Um, the last pad, was spec. We ended up negotiating a pretty good deal with the sponsorship group where, you know, they they're kind of taking on more of that risk than we are, but we'll reap the rewards if we do lease it. And right now we've got a couple of tenants kind of fighting over it at yields that, I mean, like 2 full points above the yields that we built the pre-lease buildings at. So
Right.
really, that last
Wow.
pad might end up being some serious juice for us. We underwrote it to like a high teens return, 17, 18
Yeah.
net to us. I think it's probably going to end up performing in the low 20s. I'm very excited about that deal. Again, just one where we took equity risk. It's the only equity deal that we closed last year,
Yeah.
but the sponsor checked the box, the location checked the box, and financially from a risk mitigation standpoint, right? Like they kind of checked all those boxes. They covered a lot of the risk with pre-leasing. They had enough spread over the market as is without any rent bumps or projections or anything like that. It was just a fundamentally solid deal, you know?
Yeah. Sounds like a great deal. Good for you guys. That's fantastic. And you kind of spoke this a little bit with that deal, but maybe just more generally, how do what do you look for when you're evaluating a sponsor and trying to get your head around whether a deal's worth, spending a lot of time on in terms of underwriting? And I mean, clearly, like that to me, as a sponsor and investor, understanding who the sponsor is, I feel like is the first step before you don't want to spend a bunch of time, burn a bunch of time underwriting a deal that the sponsor doesn't make sense. Maybe you can talk a little bit more about that. How do you kind of evaluate them?
Yeah, no, that's the most important thing, right? Sponsor first in every deal. I mean, obviously, location, do you think the deal makes sense? Does it check your boxes? But the sponsor is the most important part of every deal. And
Yeah.
I truly believe that. And I've learned that it's been like kind of beaten into my head at Lindell, because we've had good experiences and bad experiences, right? Just like
Sure. Yeah.
everybody else. Everyone's got their
Yeah.
war
Yeah.
stories. But, um, I'm a firm believer that a good sponsor will take a mediocre deal and make it good. A bad sponsor will take a great deal and make it a pain in the ass. There's just
Yeah.
no
Yeah.
two ways about it. That is gonna be true no
Totally.
matter what.
Yeah.
So who you do business with is the most important thing. How do we
Mm-hmm.
evaluate those GPs? How do we evaluate the sponsors? I mean, first of all, it's track record and reputation,
Sure.
right? If I don't know who you are, then probably not a great sign. If I don't know who you are, but I know people who know who you are, that's better. Look, like this is a very small community, right?
Absolutely.
Especially in Florida, to a lesser extent in the Southeast, but really in Florida. Like kind of everybody knows everybody. I spent a lot of time in banking, so I mean, I know most of the sponsor groups around the state because I either financed a deal for them or tried to finance a deal for them. You know, Carl's been in business for 50 years. He's been in the real estate business for 30 years, kind of the same thing. He's either done deals with them or tried to do a deal with them. So, kind of time in the market is a huge advantage for us, I think. Just building those relationships, knowing, kind of what people's reputations are. But generally, when we're doing diligence on a sponsor, it's what's your track record? How many deals have you done? Have you round tripped? Who have you worked with? In terms of other equity groups, can I talk to them? Can I get a reference? If we know people in common, I mean, I'll use LinkedIn for God's sake. I mean, kind of like one of the most basic tools there is. Am I connected
Sure.
with people that I'm going to
Yeah.
call them and find out a little bit about you.
Who is this
You
person?
never
Yeah.
know what kind of interactions people will remember. And then once we get dig in, if we've kind of already kind of checked the box, like we think this sponsor has the track record and is smart and has the reputation and he's got good reviews from people that he's worked with in the past. I mean, even after that, right before we go close a deal, I might pull a LexisNexis, just double check, right? It's always trust but verify. If we find a sponsor's been litigious, if we find that a bank has lost money on a sponsor, if we find that one of the equity groups that they've worked with in the past had a bad experience, I mean, those are things that are pretty sizable red flags for us. And, 9 times out of 10, things like that are going to be deal killers for us, right? We want our sponsors to have vision. We want them to have talent. We want them to have wherewithal. That's very important as well. But we want them to be good people. We want them to have honesty and integrity, and we want them to treat our capital like it's their own, right?
Yeah.
And if we hear from another equity group that hey, this guy looked out for himself before he looked out for us, it's over.
Thanks. Yeah. Yeah. I mean, I think, you and I have talked about this before, but in very much what you're describing, and is there the opportunity for a long-term relationship, right? As opposed to just a one-off. And that definitely is a meaningful piece of certainly as a sponsor looking to work with investors and family
Yeah,
offices,
yeah. I'm with you, John. So on the equity side and on the preferred equity side, absolutely. I don't like negotiating operating agreements. I don't like constantly going out and trying to, figure out how other people work. I want to have a stable of GPs that I do business with where it's like, hey, we're going to copy and paste the same operating agreement we had for the last deal. Once we approve the deal, we already know we already have all of our paperwork agreed to. Let's go. Right. That's the
more
easiest way.
efficient. Yeah.
But I'll tell you what, as we have dug into the lending business, the true first mortgage debt business,
Yeah.
which is
Yeah.
more of a hard money and bridge lender business, that business is so much different than, the relationship driven equity business, right?
Yeah. Yeah.
It's a lot more transactional, a
Yep.
lot more transactional.
Yep.
And generally, like there are some sponsors that we deal with on that side that, I would also invest equity with. There are some. But there's a lot of sponsors on that side that those deals have hair. There's a reason why people are paying me 12, 13, 14, 15% on first mortgage debt, right? It's generally because like they need to close in 2 weeks, and no bank is going to do that, right? Uh, they need more leverage than a bank is going to give them, or there's hair on that sponsor, one way or another, right?
Yeah.
Like something is there. Those are such transactional deals, and that's where we really have to be careful with those sponsors as well. Like we know that we're accepting some level of risk, and
Yeah.
like, look, our backup here is we're going to take the real estate if they don't act right, right?
Yeah. No, that's a
We
great.
never want to. We want money. We want cash, not real estate.
Yeah. Well, yeah,
But
and you don't
it's
want to
just
spend your
interesting the
time. You
dichotomy.
don't want to spend your time fighting or being litigious if you don't have to. It's too much of a waste
That's
of
right. That's
energy,
right.
right?
I mean, nobody wins in a litigious situation except for the lawyers. Like everybody knows that. We have not sued anybody since I've been here. I've never sued anybody. I don't have any interest in doing it. I mean, like not only the cost but the time factor is just it's got to be a huge suck of resources. We always try to figure out the best way to move forward with somebody without going that route. But we buy bank loans on the secondary market in our debt business. We're buying one today. Actually, we close
Okay.
on
Yeah.
from a regional bank. But that's part of the diligence when you're buying a bank loan. It's like, okay, the borrower or the guarantor, let's do some research. Have they filed bankruptcy? Have they sued a bank before? We were just looking at a pool of loans in California, super high net worth guarantors, great properties. We're like, man, we could probably buy this stuff for 75 cents on the dollar. The bank wants to get rid of the loans really badly. We're underwriting yields in the low 20s, which is incredible for us.
Hmm.
And before you know it, we're doing our our diligence and find out that some of these sponsors are throwing entities into bankruptcy left and right. And, one of them is suing one of the banks for lender liability. Like,
Yeah. Oh, jeez. Yeah.
I'm not taking that risk. I'm walking
No,
away.
thanks. Yeah.
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 Yeah. Some returns aren't worth it's not worth the time and effort and headache, right? That's
That's
for
right.
sure.
That's right.
So just zooming out, just at a high level in terms of capital markets, where put your tinfoil hat on. Where do you think where do you see interest rates kind of moving over the next 12 months? I know it's been, like you said, it's been choppy and it's been kind of unpredictable, but what are you using as a guidepost to make some of these decisions in capital allocation in terms of the capital markets? Where are you looking? What are some of the indicators maybe?
Yeah. Man, I wish I had a crystal ball. I used
Sure,
to have a
yeah.
magic 8 ball in my desk and I would just take that,
We all have to have something on a crystal ball, otherwise we wouldn't be in the market, right?
Yeah, I mean, look, I think institutionally here at Lindell Investments, our outlook is really not. It's not super rosy. I think there's a lot of groups out there that kind of think that hey, everything is okay. There's a lot of noise out there, but over the long run, rates are going to come down, and GDP is going to continue growing, and don't worry about the national debt and blah
Yeah.
blah blah. I think for us, we're a little bit more I don't want to call it like realistic or pragmatic because who freaking knows, but we're definitely a little less optimistic than that. I definitely feel that interest rates are going to stay higher for longer. I do not see long rates coming down anytime soon. The only way the long rates come down, frankly, in my view, is if the United States figures out fiscal responsibility, which good luck, or we have a major recession, right?
Yeah.
Which those are the only two ways, the only two levers. Like,
Hmm.
is the Fed going to print money and buy our own, monetize the debt? Maybe that does it, but uh,
Yeah. Is
long
that a
rates
good
are how
thing
real estate's,
necessarily? Who knows? Yeah.
yeah, long rates are how real estate is priced, right? And, everyone was saying, survive to 25, well, here we are in 2025 and the 10 years still like, hovering around 4.5.
Yeah.
We're not getting to the 3.5 that everybody thought it was going to be at. I really believe that just given structurally, like look, uh, we're getting rid of immigrants right now. We're not letting a lot of new people into the country, and we're kicking a lot of people that are already here out. Whether you think that's good policy or not, that's not what I'm here to debate, right? It's just you're taking people out of the workforce, right? Which is going to
Yeah.
create wage inflation. If there's less
Sure.
people to do the jobs, then wages have to go up. That's just the way the world works, right? Which is an inflation driver, right? If you put tariffs on things, that is an inflation driver. It makes things more expensive. Prices go up, right? Demographically in this country, right? Our birth rate is like 1.6, 1.7 live births per female
Yeah.
in this country. Like replacement level is 2.1. So we're below replacement level and we don't have in migration as strong as we used to. So again, same thing. If we're not replacing our workers, right,
Yeah.
then we're going to have to pay the limited supply of workers more,
Yep.
right,
Yep.
in the future.
Sure.
So I think those are all very inflationary things that
Mm.
just de facto are going to keep rates higher, like
Mhm.
structurally for a long time. Um, so we're not counting on rates coming down anytime soon. As far as the economy goes, I think the American economy is very dynamic. I think it would take a pretty significant event to have a deep downturn. I don't think that's our base case by any stretch of the imagination. I think we're
Mhm.
going to feel some pain in the near term, right? In the
Yeah.
next year or two. You can argue real estate has been in a rolling recession for like 2 years now. I mean, it really has been.
Definitely. Yeah.
Um, but part of the reason why everything is so prolonged is because nobody's forcing anybody's hand, right?
Yeah. Yeah. Yeah.
I said this earlier in the conversation. We haven't transacted a bunch because it feels like you need to reset basis in order
100%.
to
Absolutely.
in order to make sense of things. The only
Yep.
way basis is going to be reset, that means someone's got to lose money, right? And
Absolutely.
nobody wants
Yeah.
to lose money, so they're all trying to hang on, right? So I mean, it's debt funds are providing, high leverage. I can't believe how low the cost of capital is, but high leverage, lower cost of capital loans that are bailing some people out and giving them additional time, right, to
Yeah.
figure out what's on
Definitely.
the other side of the rainbow, right? You got banks doing extended pretend, like all that sort of thing, kind of just giving time, but not fixing the problem, right?
Yeah.
And the problem is
Yeah.
that the basis is too high for what the market is today.
Absolutely.
So, either the market is going to get better or rates are going to come down or we're going to run out of, cheap money and loan extensions and basis
Mm.
is going to get reset. And that's when people lose money. And that's when, you know, there's that ripple effect through the rest of the economy. I
Yeah.
don't know when
There's been a
I don't know when that
surprisingly
happens.
low amount of that happening, right? There's been a couple deals recently in the Tampa area. You've probably seen them in the Business Journal that have been announced where, the equity was basically wiped out. But
Yep.
I mean, when you're
And those are
underwriting,
yeah, and those
yeah,
are
go
like
ahead.
special situations where they got super high leverage acquisition financing, and the lender was underwater, you know.
Yeah. Well, and
So it's
they're
not every deal.
underwriting DSCRs and such in cap rates to such a low place in
Yeah,
2021,
yeah.
22 that
That's right. That's right.
this just was
And that's
bound to
and
happen.
frankly, yeah, that's right. And frankly, that's one of the reasons why we, have our credit business. The guy that we hired for our credit business, Brad Salzer, great guy, 30 years experience in the debt business, but you know, he's got that specific skill set to purchase debt in the secondary market. Like the opportunity right now is we're going to go do bridge debt, right? Small balance bridge loans under $10 million because we can get paid 12 to 15% to do that, right? But if the other shoe drops and some of these banks realize they've got some problems and they can't keep on extending them out, they're going to have to sell those notes, and we're positioned to take advantage.
Great. Well, I think there's going to be, yeah, like I think I definitely agree with a lot of what you're saying about the prospects for the next 12 to 24 months. I think there's no clear way that it's not choppy. It has to be a choppy kind of market that goes somewhat sideways, and if you can position yourself to grab, get yield where people maybe had made mistakes getting into deals and such in the past, and help, be a good team member there, but also, provide equity or debt, preferred equity or debt, that I think makes a ton of sense.
Yeah,
So
it's a way for us to straddle the line, right? Like we
yeah,
we, we positioned ourselves to where if things get better, we can make equity investments and grab the upside, right?
Yep.
If things
Yep.
deteriorate, we've got the credit side of the business. We can go buy bank loans. We can go do distressed deals. We can the way that we position ourselves, we feel like we can make money no matter where things go. And that was the strategic move that, brought us into this year.
Awesome. So going through the second half of 2025, it sounds like the private debt platform is a big focus. Is that what you're most excited about and focused on this year, or what's really the focus there at Lindell in terms of wrapping things up this year?
Yeah, the theme of this year is definitely the credit platform for 2025. I mean, it's a startup business, right? We are closing our warehouse facility today. So very, very
Great.
excited about that. So, that's taken a lot of time and effort on my end, on our controller's end, and on Brad's end, who's, kind of heading up that side of the house. Um, so after all that time and investment that we've put into it, we want to go build that portfolio and make sure that it's a successful business. So, that's where a lot of the focus is right now. And then, the preferred equity and the mezzanine stuff is the other part of our focus. So, we're out there. We're still trying to keep capital working, but we've got a nice chunk of dry powder on the sideline so that if we do have an opportunity on the equity side, we can jump. So that's how we've positioned ourselves, and we're very excited about what we're doing in the credit space. Just finished up our budget late last night for Lindell Capital, which is our credit business. And just based on what's like approved, signed term sheet in closing today, and what's already on the books, I couldn't ask for a better start to the year. It's going to be
Fantastic.
a great line of business for us, and I'm very, very excited about it. On the other side, we do have something that's non-real estate that I'm also very excited about. We made a
Yeah.
one-off investment in an operating business, Slide
Okay.
Insurance here in Tampa.
Oh, great.
Recently, they announced that they're going public, and
Sorry,
I've
what was
been
the name?
Slide Insurance.
Okay. Fantastic.
Yeah. As a family office, right? We're discretionary. We can be entrepreneurial and not just invest in real estate. So we took a flyer on a startup insurance company in 2022 just because we
Okay.
knew the sponsor.
Yeah.
He had already started an insurance company and took it public, made a bunch of money. He waited out his non-compete, started a new one. But right time, right place, right guy, went from 0 to 2 billion in premium in force over the course of 3 years. So absolutely
Wow.
incredible what he's been
Fantastic.
able to do.
Yeah.
And I cannot wait to see what Wall Street prices it at, but I think it's going to be a very good deal for us. Very,
And that's
very good deal.
IPOing this year, you said? That's the expectation?
It it will IPO this month.
Oh, this month, even better. Well, best of luck with that. It sounds like a great investment and great
Thank you.
opportunity. Yeah.
Thank you. Yeah.
Where can listeners go to learn more about yourself, Lindell Investments, and connect with you?
Yeah, absolutely. We have a website, www.lindellinvestments.com. Very cool website. We just redid it at the end of last year, so please visit that. You can also send me an email, mstroud@lindellinvestments.com. Feel free to reach out if you've got an opportunity for us to evaluate. We are entrepreneurial and we've got plenty of capital to place. Would love to talk to you about it.
All right. Well, thanks again for coming on today, Mark. Really enjoyed it.
Thanks, John. It was a lot of fun, man. Talk to you soon.
All right.